these inventories have gotten pretty seriously low. I think that, we could have maybe 12 months, maybe 18 left in that. The argument from there tends to be, well, there's a lot of private silver that's held, private hoards of silver, especially in the East, in Asia, for example. And so, my counter to that is, yes, there are probably several billion ounces at least of silver that's held privately. And that, the argument is that this silver will come to market if if the deficits persist. I think that they will come to market, but at much higher prices. They will come to market not at $35 or at $40, but at $45 or $50 or $60 or $70.
You're watching Capital Cosm. My name is Danny, and today's guest is silver stock investor and expert Peter Krauth. Peter, thank you so much for coming back on the show, my friend.
Danny, it is always fun, so I look forward to our chat.
Yeah, I mean, where do we start? We certainly picked a good time to do this interview, Peter. So, I'll let you take it from here. You're the big silver expert, and from my reading of the situation over the last week or so, since we've seen this massive volatility in the market, we have seen some volatility in silver, but it's held up relatively better than the broad market and most other assets. Gold has held up really well. It's at an all-time high at the time of this recording, somewhere around 32.50 right now. But I'll let you take it which direction you want. What do you make of the current happenings with all of these trade wars and how it's affected the precious metals prices and every other asset class?
So, I certainly agree with you on the precious metals. Gold and silver have held up exceptionally well. Gold clearly even better than silver has. And I guess, I can give some thoughts in terms of why I think these metals have gone the direction that they have. First of all, that they've held up well speaks to their safe haven recognition. That's always been the case. Gold in particular, gold is mostly a form of savings and inflation protection, chaos hedge, all these things. Silver is that too. I'm going to say to probably a little bit lesser of an extent because there is so much of silver that's used industrially. 10 years ago, about half of silver went into industrial applications. That's actually grown to somewhere around 60% lately. And I think that, silver peaked about 3 or 4 weeks ago around 34, almost, I think $35 if you look at the futures price. I had been calling for silver to go to 35 in the first half of this year, and we certainly got there, but it's backed off now. We're somewhere just below 32 right now, and silver actually started to back off a little bit before gold did. And this, as I say, is about 3 or 4 weeks ago. So I think that the market saw that we had increasing risks of a recession, some kind of an economic slowdown, and with more silver going to industry than gold, the concern, I think, was that, you'd have some lesser demand for silver than probably had been priced in previously. There's a lot of other factors that have been going into both metals rising pretty dramatically in the last few months. And the tariffs issue is certainly one of the biggest ones, and it is one for different reasons and from in different ways. I think what we saw too was that there was absolutely outsized quantities of silver and gold that were flowing mostly from London to New York on the fear that you'd have tariffs slapped onto these metals. And anyone who had to deliver serious quantities of either metal to contract holders basically wanted to get ahead of potential tariffs. So imagine, some large institution that has a big contract to deliver on could be, hundreds of thousands or more of ounces of these metals. And to be faced with a, 20-25% tariff on that amount, that could probably sink a lot of institutions overnight. So I think that they wanted to get the metal into the US, not have to worry about having to deliver that metal and pay tariffs on it. Now, interestingly, so that built a premium for me, at least, into the prices. Interestingly, those metals were exempt. There were several others, some base metals and some other things were exempt from the tariffs, but clearly gold and silver were exempt. So for silver, at least, that I think also contributes to the price having come back. That's sold off. Interestingly, we haven't seen that happen, or at least not for very long. Gold backed off for a very short time, a day or two after the Liberation Day announcements, and then has bounced back up and set even new all-time highs. So, I think, if this helps, some kind of an explanation of what's been going on in both metals, and maybe there's some other things that we can talk about in terms of the drivers of where things are headed.
Yeah, I know you have a few charts here that you want to flesh out. Do you want to go ahead and share those now?
Sure, let's do that.
All right. I mean, you've got some interesting stuff here, so let's go ahead and dive right in. First chart here is the SIL, which is the silver ETF, JP Morgan is the custodian of, to the silver ratio. We're looking at a year-to-date map of it. Go ahead and explain what the significance of this chart is.
Right. So SIL is actually an ETF of silver miners. There are, some exceptions because it's a large size ETF and they want to have a certain market cap size company, et cetera. So you do have some companies that don't produce much silver that are still included in there, but it's kind of widely regarded as a quote unquote larger type silver miner that this tracks an index of them. And what this is the ratio of that ETF to the price of silver. So interestingly, this is a year-to-date chart as of about yesterday. And so what we see is we've had about a 20% gain of the miners over the silver price, even with the corrections and the bounce back and so on. So basically, what it's telling me is that normally you get more leverage, but it's nice to see that since the beginning of this year, we're starting to see that kind of leverage play out. In other words, people are attributing more value relatively to the silver miners than to silver as they see the silver price rise, and how that rise in price will make its way to the bottom line for the miners and help them raise their profits and obviously become more attractive that way. So that basically tells you that it's looking like the start of a pretty attractive bull market in silver miners. Essentially, that's the bottom line.
And what I would suspect is that if you juxtapose this chart with the oil price chart, you'd see like an inverse proportionality between the two. So as the oil price goes down, the SIL silver ratio starts to go up, right? Because that's what we've been seeing over the last year to date. The oil price has faced downward pressure, so it makes sense that you would see the silver miners begin to outperform the actual metal itself.
Exactly. That's something that we've often seen. We know that oil is an important input for silver miners in terms of costs, production costs. So as oil goes down, their profits go up, and that's certainly helpful for them.
For sure. Let's go ahead and look at this next chart. So this is the London Vault data.
So this goes back to what I was saying a bit earlier about the amount of silver that's been flowing out of London. We probably talked about this in a previous interview. About a year ago, I was looking at what might be potentially capping the silver price, given that we're in multiple years of silver deficit. And actually, some of my next charts deal with that look at those numbers more specifically. But we've been in about 4 or 5 years. If you include this year, it'll be 5 years of silver deficit. The silver market's about 1 billion ounces of supply a year, and demand is about 1.2 billion ounces a year. So about 20% or 200 million ounces a year deficit. And, you'd have to ask yourself, if we're in an ongoing structural deficit, why has the silver price sort of not pushed, above 35 and continued higher and almost exploded higher? And I think this is part of the answer. So any big users and consumers of silver have not had to pressure silver miners to produce more silver. They've been able to go to these secondary inventories that sit on the LBMA in London Futures Exchange, at the COMEX in New York and in Shanghai on the Shanghai Futures Exchange, and draw down. Basically, go to these secondary inventories, buy what they need by holding long contracts, waiting for them to mature, and then taking delivery. So they've been able to get their silver this way, and buy it at prevailing prices. So we saw this start to happen in sort of early to mid 2021, is that these inventories started to draw down, and they've come down, depending on which exchange, they've come down anywhere from about 40 to 70%. Interestingly, if you look at the last few months in the LBMA, what has happened there, because that has really dropped off again dramatically to the point where it's almost becoming a critical level in terms of the silver inventories that are available for delivery. What that speaks to, I think, is more the metal flowing out of London and into New York. So what I'd like, how about if we switch to that next chart?
Yeah, sure. Just one quick observation. I think it's interesting here. If you look at the last, I mean, prior to this, to the recent dips, if you look at the last two dips prior to that, which is 2022 and 2020, all of those occurred during, these once in a lifetime events, 2020 being COVID, 2022 being the start of the Ukraine war. So as soon as the Ukraine war started, you saw this massive exodus out of silver, out of London. And so it begs the question, what's the Bohr standard deviation event, or some far out Six Sigma event that will correspond to this exodus. So just thought I'd point that out.
Exactly.
Okay, so you got the COMEX Depository Warehouse Silver. Walk through this one.
Yeah, so this is almost like it's the mirror image of what's been happening in London, right? So, and especially for the last few months, we have outsized deliveries of silver coming out of London, and outsized deliveries going into the COMEX in New York.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
And so this explains where a lot of the silver from London has ended up. So, some people will say, is there a shortage in silver? So a couple of thoughts around that. Technically, silver flowing from London to New York doesn't cause a shortage. It just changes where the silver is held. However, if you look at the next chart, then you'll see what is happening when it comes to the silver ending up in New York. So we see that very last bar all the way over on the right. March deliveries out of the COMEX, silver deliveries, are the second highest in COMEX history. And so what it means is that not only is the silver flowing to New York from London, but participants are taking delivery. They're requesting and getting their silver out of the COMEX. This is very telling. I think that what happens is you've probably got, in both, my view is that you probably have industrial users and some sort of institutional financial participants saying, we are not going to leave this on the exchange even if we have our futures contract with a claim for it. The industrial users are taking delivery because they need it and don't want to have to pay tariffs, or didn't want to have to pay potential tariffs on it. And then the financial participants are saying, we want to have our hands on the physical silver, ahead of any potential run up, I think, in the price. And so this, again, I think is very telling, that to see these huge amounts of deliveries. I mean, I've heard anecdotally that there's a lot of, in addition to this, that a lot of the silver that has flowed into New York has gone into the COMEX, a lot of it has also just gone straight to private vaults in the New York area, just sort of sitting there, probably owned by some of the investment banks and so on, the bullion banks, and just basically sitting on a position and being ready in case that you get this potential large move up in the silver price. So if you could, we can talk a little bit about what I mentioned earlier in some of the fundamentals in the next chart.
Sure.
So I was talking about silver deficits. So these 5 red bars all the way on the right are including this year. So this last year is an estimate, and that is 149 million ounces. I think that's what the Silver Institute is expecting that we're going to see this year in terms of a shortage. I think it's actually going to be closer to what we had last year, around 180 million ounces. But the point is that if you take the average of these last 5 years, pretty significant structural deficits, you're somewhere around 200 million ounces per year. And if you add these 5 years together, that's an entire year's supply of silver when you combine mining and recycling. So about 1 billion ounces. So we're in deficit of 1 billion ounces across the last 5 years. That is really quite something. And the fact that the silver price has not exploded in this kind of environment tells me that yes, those consumers of the silver have, again, that to me explains what we saw in that earlier chart from London, and the charts for the COMEX and for Shanghai are similar in terms of drawdown of silver the last 4 years. So I think that is clearly tells us that's what has met these deficits, but that can only go on for so long. These inventories have gotten pretty seriously low. I think that we could have maybe 12 months, maybe 18 left in that. The argument from there tends to be, well, there's a lot of private silver that's held, private hoards of silver, especially in the East in Asia, for example. And so, my counter to that is, yes, there are probably several billion ounces at least of silver that's held privately, and that the argument is that this silver will come to market if if the deficits persist. I think that they will come to market, but at much higher prices. They will come to market not at $35 or at $40, but at $45 or $50 or $60 or $70. That's when those people will be willing to sell their silver back into the market and help to meet these deficits. And at that point, that's that, so to speak, self-fulfilling prophecy where you've gotten that's helped to push these silver prices higher. And if you can move on to that last chart that I have.
Sure. Just one follow-up question here,
sure.
Peter. Are these deficits an artifact of increasing demand or a decreasing supply of production? I mean, what's driving these deficits, would you say?
So the production is flat. Essentially, it's flat. Mm-hmm. So that's interesting because you can clearly point to the other side of the equation being the demand, because the demand has been rising and is up so significantly, especially in the last 10 years. So given that supply is essentially flat for the last 10 years, this comes from demand, certainly a higher demand. And I think that the 800-pound gorilla is solar demand. I want to kind of, maybe if we could go back for a second to what we talked about very early in the interview, which was, silver coming off because of a concern about an economic slowdown and a lot of silver going to industrial applications. And now by far, solar is the single largest industrial application for silver. Well, you could argue that if there's an economic slowdown, we're going to produce less solar panels. Well, what's interesting is that, if there's so many counter arguments to this. If you look back over the last, say, 5 years or 10 years, the 5 year out forecasts, if you took the average of those forecasts for the amount of solar panel installations, they were consistently off by 2/3, meaning that we had 3 times more solar installations than we had predicted. And these are, large outfits that are serious outfits that do these forecasts, and they were on average off by 2/3. So we consistently produce and install more solar panels than we expect. Last year, to give you some kind of perspective, in the US, solar combined with wind, in terms of electricity produced, and solar is certainly the much bigger portion of those two renewables, but combined, they, for the first time ever, produced more electricity than coal did in the US. And we see that trend rising tremendously. And I've seen forecasts where, you go out to maybe 10 or 15 or 20 years, and solar will be the single most dominant source of electricity globally. And there's a lot of good reasons for that. It's fast to set up, it's easy to permit, it's obviously clean. Obviously, after 20, 25 years, it will have to be replaced, but we'll find ways to recycle and recoup some of the materials in that as well. But going back to that, that thought about an economic slowdown and potentially producing less solar panels, even if solar panel production were to grow at a slower pace, what's interesting to note is the technology and how that's changing. So until about a year or two ago, we had this one dominant technology that had been the main technology for several years. And these are all acronyms, but it's called PERC. And it used a certain amount of silver for each panel. Well, what has already in the last couple of years become the new dominant technology is called TOPCon. And that uses up to 50% more silver per panel. So being that we're switching very quickly to this new technology for solar panels, that is keeping the consumption of silver for the solar industry really quite high, and even potentially growing, even if we have a bit of a slowdown in the growth, as I say, in the growth of solar panel production. And if you look at the technology that's likely to follow on from TOPCon, that's called HJT. That takes up to 150% more silver per solar panel. So, your viewers might ask, well, why are you going to produce solar panels that require more silver? Well, it comes down to one simple thing, and that is that these panels are more advanced and they produce more electricity. So the cost of the additional silver is more than offset by the energy that these new panels produce. So, these things counterbalance, I think, or counter potential or concerns about slowdowns in silver consumption industrially. And I think that, those concerns are probably somewhat overblown. If we do get an economic slowdown, we're likely to have all kinds of stimulus programs. Green transition, green energy is always an easy sell. And so I think we're going to continue to see plenty of money flow into solar in particular. So that demand, I think, will hold up.
I see. And it's very interesting. Again, this spike in demand just occurred right after 2020. So
absolutely. And so that's I'm glad you bring that up, because I just finished saying that, when we get the next recession, we're going to have stimulus again. And if you look back at the two last, large economic events that caused big stimulus globally, in fact, you had the financial crisis of 08, 09, and then you had COVID. In both instances, governments came around and very quickly decided to print a lot of money and have these stimulus programs. And they involved, for the most part, they involved infrastructure, and they involved the transition to a greener economy. Well, the reason for that, I believe, is that because they're relatively easy sells, right? You're not going to have much pushback if you say, we're going to spend X tens or billions or hundreds of billions of dollars on these, green transition programs and or on infrastructure, because most people will say, well, I get to benefit from that. And so I can accept that you're going to spend that kind of money on these kinds of programs. We saw that happen both times. We saw that happen in the financial crisis. We saw it again in COVID. And I think that points to that bump in, 2022?
Mm-hmm.
um, for silver consumption, or for the deficit, because that's when that money started to really kick in and we saw a big spend on solar in particular.
Gotcha. Let's go ahead and move over to the next slide. So we've got global mine production of silver, and it's been going down, it would seem. I'll let you run with this one. What are we
Yeah,
looking at
so
here?
that speaks to what I was saying earlier, is that we've got it was S&P Global Intelligence. I saw their research a few months back, and they were saying that if you look at the output from primary silver mines, because about 25% of mined silver comes from primary silver mines, and the other 75% comes as a byproduct of mining other metals like copper, gold, lead, or zinc. And so they were talking about primary silver mines, and they said that they saw all the way out to 2027 that the silver output from those mines would actually continue to drop. And this chart in particular is silver, mined silver overall, both from primary and from byproduct silver mines. And what we see is that the output peaked actually in 2016, and it's dropped off considerably, and it's been bouncing a little bit lately, but we're somewhere around the 820 million ounce level. And the outlook is that this is not going to change very much at all, and that the demand is going to stay somewhere around the 120 billion ounce level. So to be clear, some of the supply comes from recycling. It represents about 15% of the annual supply of silver, but then the rest of it is coming from these above ground existing inventories, because, as I say, we're consuming 1.2 billion ounces, but we're only producing 1 billion ounces a year. So I think the big move that we saw last year in silver, when in February it was trading around $22, and then it ran up basically to like $34, $35, I think it was in October. I think that was the market coming to terms finally with the fact that we are facing these ongoing structural deficits in the silver market, and that the inventories are only going to last so long. Mine supply is not keeping up with it. These private hoards of silver would and will eventually come to supply the market, but they will only do that at much higher prices. And that's what I think the market is sniffing out.
Gotcha. And I think that's the end of the PowerPoint. So let's
It
go
is.
ahead and talk about the broad market here. I'm looking at bonds, and more specifically the 10-year yield, and it's at over 4.5% now. And the reason why I bring this up and wanted to tie this in with the silver analysis here is that it doesn't appear the conventional thinking is when you have like these big market corrections, investors flock to bonds for safety, but that's not happening. They're either staying in cash, or dare I say, just by looking at the gold price and to a lesser extent the silver price, it seems like they're moving to precious metals and cash as safe havens and not bonds. So gold sitting at $3,200, silver sitting at $31. Is this where retail wakes up and starts to these metals start to catch a bit from not just the institutional side, not just the governmental side that's been accumulating all of this gold and silver, more specifically gold. Is this when retail begins to get in on the action when it comes to silver?
I think so. I mean, I think, you look at the gold silver ratio, we're back over 100 right now. That's very atypical. We were over 100 in the depths of COVID when it went to, I think it was very temporarily at 125. And then eventually, dropped quite significantly, especially as silver rallied pretty strongly. But yeah, I do think that, at some point, it's interesting that it's gold's rally to me still very much looks like a stealth rally. A
Mm-hmm.
lot of people, and that's almost the best kind, because when it becomes mainstream, that's when it's due for a pause, right? It becomes overbought. Everyone's in, so to speak, and then it starts to dial back, and we haven't really seen that yet. My sense is still that, the dollar sold off dramatically. That is another typical safe haven
Mm-hmm.
that did not hold up. I do think it's probably kind of oversold at this point because it's been such a dramatic drop in a matter of days, a week, perhaps. Um, I would not be surprised to see a bounce in the dollar. Um, as you mentioned, the bonds, the yields just soaring, meaning that people are selling those bonds. So they're clearly not the safe haven either. I think that, yes, people have, even if it's not mainstream, there's a lot of smart money that has started to finally move into gold. And it's always the best informed and the largest and the most astute money that moves first for different reasons. I mean, the fact that they're astute means they've accumulated the capital, that they're trying to protect it and trying to preserve it. And so they have great information. They do the research. They see, what things are likely to move in which direction, and they look at what's most undervalued. And I think that we're starting to see a rotation, frankly, from the broader markets to the commodities space that has been tremendously undervalued for a long time, and the precious metals in particular. And so, yes, that's a move, I think, a sustained move to gold. I wouldn't be surprised to see it, back off a little bit here. This is pretty exceptional, and it's maybe looking a little bit overbought. If it does correct, I'd see that as a great opportunity. But I do see that people paying attention to gold at these levels will start to get them thinking. And they'll see gold at, say, $3,200 and say, wow, that's pretty rich. Like, I'm getting 1 ounce of gold for $3,200. A year ago, we were in the low 2000s, or a little bit longer than that. It's pretty impressive. It's quite the run up. And what are my other options? And silver is always that natural other option. And silver, where you're getting 100 ounces or slightly more of silver for every ounce of gold, makes it very attractive. And it becomes, again, I guess, once again, viewed as the people's money, so to speak. And I do think we're going to see a significant move in silver. It may take, a matter of a few months still before it starts to kick in. But I think that we're going to see considerably higher prices, at least in the second half of this year.
Gotcha. Well, I mean, this is why I try to do my best in finding resources for my audience. I've looked and scoured, and I pretty much recommend to you guys what I use, and that is my favorite newsletter, and that is Capitalist Exploits. On top of that, we've also managed to get a $1,000 discount for Capital Cosm viewers. And the reason why I recommend Capitalist Exploits is that Chris and Brad, if you haven't seen my interviews with them, I just did an interview with them a couple of days ago. You can go and check that out. But they really do outside of the box thinking and using politically incorrect thinking when it comes to this this market. So I can't recommend them enough. The way I kind of look at it is, if I'm the CEO of my portfolio, a newsletter like Capitalist Exploits is kind of like my outsourced research team. So go ahead and check them out. Link is down below. Peter, thank you so much for coming on, my friend. Anything else that you want to get into before we wrap things up here?
I mean, we've certainly covered the space pretty well in terms of what the latest happenings are. I think that people should consider both gold and silver. And silver, by far, being that it's trading at 100 to 1 versus gold right now, is certainly historically very cheap. And that makes it especially attractive at this time. And if anyone's interested in buying physical silver, something I want to point out too is that I look at this very regularly, and the premiums on physical silver right now are quite attractive. When we hit the COVID panic, premiums on silver just blew out. They went from the typical, say, 12 to 15% over the spot price. And some people were paying up to 75 or even 100% over spot. And they were waiting in some cases weeks or months for delivery. The supply was just that tight. And right now, deliveries are back to normal, typically a matter of a few days. And the premiums are in the sort of 15, 16% range, which is a lot more reasonable. It's certainly within the normal range. And I think that makes silver very attractive at this point.
Awesome. Well, thank you so much for coming on, Peter. Where can people find you if they want to hear and see more?
So I publish the Silver Stock Investor newsletter. That is what I consider a real-time way to follow what's going on in silver. I cover silver miners and everything from some silver mining ETFs and even some physically backed silver ETFs, all the way down through the large royalty companies, large producers, and all the way to junior silver explorers. I published a book a couple of years ago called The Great Silver Bull, and I think that's a good way to get an overview of the entire opportunity in silver. It's kind of a great introduction to investing in silver overall. And I just recently launched, beginning of this year, a new newsletter that's a free one called Silver Advisor. So what I do is I follow companies in the silver space, and we review their news, analyze it, and comment on it. And it's a great, easy, free way for people to get an introduction to investing in silver miners. And so if they want to look for that, it's the Silver Advisor. You can go to thegoldadvisor.com/registration and sign up there, and you'll start getting our newsletter.
Excellent. We'll have the link to that down below. Peter, thank you so much for coming on again. Guys, if you enjoyed this podcast, be sure to give us a like and subscribe to the channel so you don't miss another episode, and to help us out as well. It may not seem like much, but a little bit does go a long way. Also, check us out on Substack. It's capitalcosm.substack.com, where you can get early access and ad-free versions of all of my content before the YouTube audience does, and without having to deal with the hassle of all these YouTube ads. And then finally, check out my good partners over at Pimbex. That's PIMBEX.com for all of your gold and silver buying needs. Guys, I really appreciated your time here. Thank you for watching, and I will catch you in the next episode. Bye.